Alrighty, what's going on, guys? I'm going to be talking to you guys today about an option strategy that I find very interesting. I think it's a really cool one. It's called the Iron Butterfly. This is basically what the P&L chart looks like. So we'll talk about what you need to get this max loss right here, and to keep these keep this max gain right here, and to have it so that your max loss is set to a very, very low number, and increase your overall probability of hitting somewhere in this range right here. So when you're selling an Iron Butterfly, it's basically made up of they're called legs, 4 different parts. So the first 2 parts are the things you're going to be selling, or the contracts you're going to be selling, and this is where your money comes in. So it's kind of like a really important part of the butterfly itself. So you're going to be, make this red, you're going to be selling a call, and you're going to be selling a put, and both of these are going to be at the same strike. This sets it up so that you get this triangle right here. That's how this triangle is formed, because selling calls and selling puts, they have opposite effects on each other, which is why, as you see, where's my mouse? As you see the price go up, obviously you're going to see that put lose value, selling this put lose value, and as it goes up, you're going to see the call you sold losing value, and as it goes down, you're going to see the put you sold losing value. Now, the next 2 legs are what brings in this low loss to profit ratio, I guess is what you would call it. It's what keeps this loss tight to 0. So if we didn't have this next part that I'm about to talk about, our P&L chart would basically look like this. Because after a certain point, the premium we received from our put would not match the loss that would not match the loss from our call if the price were to keep going up, and the loss or the gain from our call would not mitigate the loss from our put if it were to keep going against our put sell. So the last 2 parts you're actually going to be buying. So you're going to be buying a call above the strike that you sold, above this strike, and then you're going to be buying put below these. So what this is doing is it's basically putting you in a situation where, let's talk about if the price were to finish above the strike price. So what you're seeing as this is going down, you're seeing as the price goes up, you're seeing the call that we bought gain value. So this value is going up. You're seeing the put that we got lose value. So this is slowly losing value. You're seeing the call that we sold lose value. So this is going down. This is going up. This is going down as well, and the call is going up, and then the put that we sold is going up. That's what happens when the price is going up. As the price is going down, the call that we sold is going to maintain its value. Basically, you're going to be getting the max gain from the call. The put that we sold is going to be going down in value, because when you buy a put, you're bearish, so if the price goes down, the put you sold is going to lose value. If you buy a put and the price goes down, the value of your put goes up. So if you sold a put and the price goes down, the value of your put is going to go down. So, and then this is going to go down, and this is going to go up. So, the reason that you experience max gain on when you have the price of the underlying finish at exactly the strike price is because let's actually just walk through what an iron butterfly would look like with the SPY charts. So let's say that in 5 days on March 17th, today's date is March 12th, let's say in 5 days on March 17th, you think the price is going to be exactly $3.96. So you're going to you're going to sell the call and the put at the $3.96. So selling the call would be $157 and selling the put would be $3.45. So this is $3.45 and this is $157. So basically we're selling these, right? 157. It's actually 341, isn't it? It's 341, not 345. 341. So doing some quick math, that means that our total credit received 341 plus 157. That is $504. So our credit is $504. And then we're going to buy the call above the strike, and then we're going to buy the put below. So for me and how I think that I would execute this trade, I haven't executed a trade on SPY before. I don't know how SPY trades, so I'm just doing this as an example. But I would say that for my lower leg, I would buy this put right around the 393. So this would be 204. So we're buying the 204, and then that's the put, and then for the call, we would want to buy the 399, so it would be $66 for that one. So this means that we would get a net credit of 504 minus 204 minus 66 is $234. So that is our max gain, is $234. Because basically what we want is we want both of these contracts to expire worthless. But we really want both of these contracts to expire worthless. They are only there for insurance. They're only there if the market makes a big move that we weren't expecting. You know, we're selling the 396 strike price, but let's say that something crazy happens and this drops to 390, or this runs all the way up to 410, then all we're experiencing is this max loss instead of these max losses. So if we jump into our Webull account and we go to the Iron Butterfly, we're looking at the 396. We are selling the 396. If we increase our width here to $3, as you can see, we gotta bring the contracts down to, there we go. So Webull's coming through a little bit different. This is, I don't really know why ours is $2 different. I might have done math a little bit wrong somewhere. Prices might have changed somewhere because markets still are open. But I think it has to do, it has to do with this limit price. Obviously, we we could sell this for 234 instead of 232. But as you guys can see, our max loss is right around the 224 mark. Pretty close to what we got. I'm sure there's other things that I'm not taking into consideration. I'm sure prices are moving still. But our max loss is only $69. So when you enter into this trade, you actually receive more money than you pay. Even if you buy it immediately without trying to maximize your position in this trade, you receive more money than you spend. Because what you're buying is actually insurance policies. You're not putting yourself at a disadvantage hoping to sell it. You're not buying and hoping to sell for more. You're getting the money up front and then hoping you're right. So that's why this is a little bit different than trading stocks or day trading options. You're trying to predict the price, which some people consider impossible, but there is technical analysis, and you can really ramp up your width here. So if we were to bring this the width here all the way to 15, and then we were to let's just say that we thought that we were going to have a big week and this was going to run all the way to $403. So, I mean, our max loss is all the way up in the 800s. However, our max loss is also in the 600s. So, it's as you increase your width, like you're giving yourself more room to win and you're bringing more money to the table, but you're also exposing yourself to more of a loss. Because remember, you're not losing $600 from this $800. This is, you received $800, you have to give all that back, and you have to pay $600. So that's what these P&L charts are. This is not a guaranteed win. There are a lot of ways that you can kind of game these, especially on lower volume stocks. Just make sure that you don't screw yourself over with the trade. So as far as maximizing your position in these, it is possible to do. I don't really recommend it. Timing the market is very difficult. Even experienced traders will get really messed up trying to time their way into 4 different options contracts. But basically, you would want to sell this call when it's as close to, or when it is in the money, or very close to. And then you would want to do the same with this put, when it is in the money or very close to it. This is basically maximizing the amount of credit that you're receiving. So if you were to sell the 157 call when the price of the underlying was only 155, as you can see, if we go to the single options, when you're buying calls, right, as the price goes up, you're making more money. So if we were to see, like, this is $2 out of the money. So if we were to sell this 396 way up when it was 396, we would be able to receive $256 instead of just 157. And then once it gets all the way down to 396, we don't even have to we don't have to sell the put right away. We can wait until it gets down to 398, and then we can sell that for $341 basically, because it's going to be, we would want it to go down, which is this way, because this is inverse. That always throws me off. But we would wait for it to go down to 394, and then this would be worth 403 instead of just 341. And so see, just by being a little bit patient, what you've basically done is you've increased your money. Let's say that we were to get it, we were able to sell our call for 256, and sell our put for 473. That's a net gain of over 700. It's like $730 ish. So instead of just $504, now we've got $730. And then when you're buying your insurance, you could just do it when it's cheaper. So you're selling this 396 call when it's in the money, but maybe that's when you buy the you would want the call to be lower. So when it's all the way up here and you're looking to sell your put, that's when you're also looking to buy your call. So it would be cheaper. So you're buying these for cheaper. These costs would be cheaper. So basically what we've done now is we've increased the credit we're receiving and decreased the amount we're paying by properly timing the market, which in turn increases our profit and lowers our max loss as well. So that's pretty much all I have for you guys. I'm going to be releasing more option strategies videos throughout the week, getting you guys filled in on all the different option strategies there are, why you would use them, when you could use them. I recommend using iron butterflies after big run-ups. Or complete stagnation. And the only reason that I'm recommending both of these situations is because after big run-ups, you tend to have stagnation. I know a lot of times in stocks what we've seen recently is things like this. They go up really sharp like this, and they come back down super sharp like this, and they just kind of go like this, and it's really frustrating because you bought right here. But I recommend that you guys, when we're talking options, right, I recommend you guys actually trade indexes and ETFs. These are going to be, especially the indexes are going to be a little more expensive. SPY puts are very expensive. They're like $30,000 each. But ETFs have a lot less volatility to them, which is kind of what we want with options. Volatility with options is bad. I don't want to say it's bad because it's good sometimes, but it's bad because it's harder to predict where the price will go with more volatility. You don't know when the buyers are going to come, you don't know when the sellers are going to come, you don't know when you're going to get hit with news, you don't know a whole bunch of stuff. So honestly, flat markets are, in my opinion, what's best for trading option strategies. Obviously with naked options where you're not have a strategy, you just have a single option, you obviously want it to fly one way or the other. That's a little different. But iron butterflies obviously work very well in neutral markets because you're able to pinpoint a relative range of where it could land, and then you're able to set up an iron butterfly where you're profitable in that range. The next video I'm going to be bringing you guys is going to be talking about an option strategy called the Iron Condor, which is really the premier way to make money in a sideways market, even better than this, because there is a lot less. You have a much wider range, and your max profit stays in for much longer. But that's for the next video, guys, so be sure to tune in for that one, and thanks to you guys for watching this one. Take care.